Good afternoon, everyone. Welcome to Stock Durbar with Team MarketSmith India. My name is Rashika Kongani. I'm part of MarketSmith India team, and in this session we have with us colleagues Mr. Shita and Wakar, and as well as our head of research, Mr. Mayur Jeshi, also joining us. We'll start this session with an introduction about how the markets are placed at the current moment, and we'll in the later half of the session, we'll talk about your stock specific queries. And for the first 10 to 15 minutes, I'll be discussing about Nifty's placement as well as the key indices placement and what are the levels we are looking at according to our own lens. First, this is Nifty's chart, as you can see. Uh, Currently, Nifty is trading very close towards at its 21 DMA. Recently, it's Nifty has reclaimed its 50 and 21 DMA, and today's session, you can say it's a very muted action. It in a very narrow region. And with respect to distribution day count, we are at 4, and one of the distribution day has expired during the week, as well as one distribution day was added uh, during the week as well. And on the net basis, our distribution day count is at 4, and Nifty is trading clearly above its 50 DMA. So we are comfortably in trading in the confirmed uptrend. On the downside, if there is any addition of a couple of distribution days, and if the Nifty breaches its key moving averages, we would change the market status to under pressure. On the upside, there is some overhead supply for the index. Another 2 to 3% there is overhead supply. So there might be some resistance for the Nifty going forward on the upside. On the downside, 50 DMA is going to be a very crucial level. And even though it was breached for a brief moment, the 50 DMA breach was on the lower volume. That was a very positive sign. And going forward, if that level is breached on the higher volume, then definitely there might be some selling happening in the markets. And if the distribution day count also increases by a couple of distribution days going forward, we might change the market status to under pressure. And the ending season has started, and TCS has also come up with their results. Uh, Even though TCS, especially on the profit margin wise, TCS has come up with very good set of results. The profit has come above street estimates, but the street has taken the results on the negative side, and the stock has came under selling pressure. You can see it has breached its 21 DMA, and it was down nearly 2% on more than 100% average volumes. So the market movement is going to be determined by the uh, Q2 results going forward. Started with the TCS, Infosys, and other key IT companies are going to report in this uh, in the coming sessions, and index heavyweights such as TCS, Infosys, and HDFC, Reliance. If the results come out very good, definitely market is going to hold up and might make a new all-time high. But if these companies come up with not so good results, definitely the index is going to come under some kind of pressure. Coming to some one of the key index, that is sectoral index, Nifty Bank. It is trading very crucial. It is very crucial level, that is near its 150 DMA. It is very crucial. That is around 44,600 700 levels. So Nifty, this index, Nifty Bank has been trading very close to that level in the last 10 to 15 trading sessions. Uh, Going forward, we would like to fight for the index to reclaim these levels. And currently there is some 4% of overhead supply for the index, similar to the Nifty index, and the volume has also been on the lower side during this consolidation. Again, a positive sign. So not so much action in the banking space as well, and going forward, banks such as HDFC, ICICI are expected to come up with their results going forward, and the company, if the banks, large cap banks, come up with good results, definitely Nifty Bank scaling a new high will result in a Nifty scaling a new high as well. On the downside, this Nifty Bank, especially this 200 EM is going to be a very crucial level for the index. That is one another 3% downside, and you might see some kind of support for the index at this level. If that level is also breached, we might expect some selling in the banking spaces. Moving on to another key sector index, that is Nifty IT. Today's action is not captured in this chart actually. It will be captured after 6 p.m. In the evening. But as mentioned previously, Nifty the IT, one of the key constituent and major constituent is the TCS has come up with good set of numbers, but the stock has reacted negatively towards the results, and you can see Nifty IT has been trading very close towards its 21 DMA, and it is just 2.5% from its all-time highs. So there is a very less overhead supply for this index particularly, and Infosys and HCL Technologies are going to report their numbers in the coming sessions. And if the numbers come up good, and if the company reports a good set of growth in terms of guidance, especially, then definitely Nifty IT is going to make a new all-time high, and stocks such as TCS, Infosys are going to move higher as well. On the downside, we can expect a very good support at its 50 DMA, which is another 2.5 or 2.7% from here. Moving on to next index, sectoral index, which is a very key index in terms of weightage as well as the overall performance related for the Nifty. That is Nifty FMCG. You can see Nifty FMCG has clearly reclaimed its key moving averages for the last 1 month or so. It has been trading very close towards its 50 and 21 DMAs, and recently it has reclaimed those levels on a very good set of volume as well. And there is only 3% overhead supply for this index going on the upside, so that might be some kind of resistance. But as the ending season upon us, and also election season is also coming up in nearly 5 states, so definitely government is going to announce key reforms related to consumption, and these measures are going to definitely push up the FMCG growth as well going forward. And Nifty FMCG making a new all-time high is going to always be a very bullish sign for the Indian markets as well. On the downside, the key moving averages are very close towards the current market price for the FMCG. You can see 50 DMA and 21 and 100 DMAs are very close. There are less than 1% from the market price, and 200 DMA is nearly 7% from the current market price. So if these key moving averages are breached at higher volume, then the next support is for the FMCG is at 200 DMA, but that is a very long way going from here 7%. So these moving averages are breached on higher volume, so definitely we can expect a selling pressure coming to the FMCG spaces, especially because there is no near-term support for the index. Another key index, even though the overall weightage for the index is on the lower side, but Nifty Realty has been playing very good, or you can say trading very good at the current market. And you can see here it is clearly trading. Uh, you can say it is outperforming the overall market, even though Nifty is 3% from the highs, 3 to 4%. And key sectoral indices, Nifty Bank, FMCG, Nifty IT, we have already seen are nearly 3 to 4 or 7% from the all-time highs. This index is clearly outperforming these indices, or you can say it is leading the market in the current uh, profit booking or selling zone. It is clearly trading above its key moving averages. 21 DMA is more than 5% from here, and 50 DMA is nearly 9% from here. On the downside, these levels are going to be can be considered as a good level of support. And historically or previously, if you consider, you can see 50 DMA has acted as a very good set of support for the index. And during this current sell-off, you can see this 50 DM has not been tested by the Nifty Realty Index. Again, a very positive sign, or you can say a very constructive sign on the Nifty Realty basis, you can say. So that is with some of the key indices and the overall market. I'll move on to key, that is broader market indices, mid cap and small cap. Then we'll take on the stock specific queries. This is Nifty Midcap index, that is Nifty Midcap 100, which we track normally on our mailers in the evening and morning emailers. This is also very similar to the Nifty index movement. It is just 3% from the all-time highs. It is trading very close towards its 21 DMA, and 50 DMA has not been tested during the current sell-off, a very positive sign. So in the broader market spaces, these small cap and mid cap spaces are very constructive. The rally is still intact, even though the Nifty has tested 50 DMA and successfully reclaimed 50 DMA. In the broader market spaces, mid cap especially, this 50 DMA has been not touched, or it has not been breached, a very positive sign. And if the broader market indices come up with a good set of rally, definitely overall breakouts happening in the market will be on the higher side, and also the successful factor of the breakouts will be on the higher side. Next is Nifty small cap index. It is also very similar to the mid cap, which we have discussed. Only 21 DMA has been tested recently, and that level has been held very constructively. You can see, even though it was breached for a brief moment of a couple of sessions, but that level has been reclaimed by the index in a very short span of time. Again, a positive sign. 50 DMA has not been tested at all uh, when compared to Nifty. So in the broader market spaces, the rally has been staying intact. Only the problem is with Nifty not holding the 50 DMA, but currently that level is also being reclaimed. So the overall the rally is still intact. That is the reason we are still staying in confirmed upgrade. And if there are any breakouts happening in the market, you can see today also we have added a stock to our portfolio as well. So if there are any strong breakouts, stocks with a very good set of ratings breaking out on above average volumes, definitely we would consider for addition to portfolio. And coming to current model portfolio stocks, if there are any stocks which are moving sideways or coming under pressure or breaching their key moving average, we would definitely exit those stocks from our model portfolio.
Yeah,
Now,
thanks, Raj.
yeah.
Yeah, please continue.
Yeah, now we can start with the stock specific queries, Rushik.
Sure. Please do not junk the chat box. Just keep it the query once, so it will be easy to scroll through, because it's a live session. So if you repeat the queries multiple times, then it might be tough to scroll up. Okay, let's start with the first query. That's on the HDFC Bank. Broadly, the stock has been under pressure after its merger with the HDFC and HDFC Bank merger. So currently, it is trading below all its key moving average, and it had given some clean sell signals, or you can say you can book profit or exit that stock a couple of months back only, when it had reached its 50 as well as 20 DMA on a relatively higher volume. So if you can see, even the buyer demand, it's very poor at D plus, and the relative strength is just only 20. As Rajshekhar is indicating, there was a huge gap down. From there, it never able to reclaim those key moving averages. So it's a fresh buy. You need to wait for some base formation and the improvements in the rating, because the group rank is poor, the price trend is just 20. So you need some good incremental improvement in the price trend as well as the buyer demand, plus some good couple of results, couple of quarter results and a base formation before entering the stocks. Now, if you are already holding the stock, it has already breached most of all the key moving averages. So you need to manage your risk well. Ideally, William O'Neill always suggests to use 7 to 8% as a stop loss, and if it is below some 50 and 200 DMA on a higher volume, you should cut the losses or book the profit. The next we can take is Triveni Turbine. The stock had recently given a breakout from a double bottom base, but it moved sideways in the ideal buy zone. Breakout के range के around वो side में almost couple of weeks it tried to move higher, but it found resistance near around 450 zone for multiple times, at least 3 to 4 times, as Rajshekhar is indicating. But at last it failed and it breached its 21 as well as the 50-day moving average. So if you have bought the stock at around the breakout zone, or if you are already holding the stock, and according to O'Neill methodology, the stock has breached the key moving averages and you should cut your losses. And if you had invested a way back, like before this double bottom, there was a flat base, the cup with handle breakout or sometime there. And if you are having a decent gain, then ideally booking is good if the stock has breached its 50 DMA. So overall, it's a good long-term story, but the technical doesn't support the fresh entry over here. However, if we see that there is some high volume and the increase in the relative strength as well as the buyer demand, and it reclaims its key moving averages, then when it falls again in the buy zone at the re-breakout point, that's the time you need to review the stock again. Now let's take NCC. The last 6 months have been very, very good for the stock. The price volume action was very constructive. So it had formed the cup with handle base some 3 to 4 months back. And after the breakout around 100 rupees, it continuously went higher. So it found a very good support near its 50 DMA. There was only one instance when 50 DMA was breached. But on the second day itself, it again reclaimed that level and continued to move higher. So currently, since last 3 to 4 weeks, it was consolidating around that 158, 160 level. But today it just gave a breakout from that level, and look at the volume bar. So today the volume was very high. And if you look at the volume of last 7 to 8 sessions, when the stock was consolidating just about its 50 and 21 DMA, the volume was on the lower side. So these are the things you need to observe on the chart. When given a breakout, you can add further. So it has already given an alternate buy point because it has rebounded from its 50 DMA on a relatively higher volume. But I think today it has moved already more than 5%. So it's little above the ideal zone that you might look to buy. Otherwise, fundamentally the stock is good. If you look at the order book, so we recently they came out with the last month's new order wins. Even the last quarter results were very good, and the number of fund holding the stocks is also improving. So if you consider last quarter, almost 14% increase on a QOQ basis in the number of funds. So the technicals, fundamentals, as well as the growth story wise, the Indian infra story and the government spending. So all these supports NCC. So it's a good quality stock, need to keep in radar. So whenever you get a chance near 50 DMA to add, you can do it. Otherwise, you need to wait for a fresh base formation. So once that base is formed on breakout, it's an ideal buy point according to only.
Thanks, Roshit. Vakari, I'll take in some queries now.
Sure.
Raj, can you give me the chart for Neuland Labs? I mean, pretty similar run up to the last chart, as you can see. I mean, overall, the ratings for the stock are excellent. Plus, if you see the fund holding for the stock, that has been improving very, very well. And it's a really good sign, as you can see. The last few results for the stock has also been very good. And the next result is more than a month away, as you can see now. Not just the last three results. I mean, you look at, I mean, the last entire result, the FY23 plus the Q1 FY24 for the stock have been very, very good. ROE for the stock at 17% has been very good. The previous breakout for the stock was very successful. As you can see, the stock broke out an above average volume, found support near the 21 DMA, rebounded very, very well from that 21 DMA, as you can see. And during the entire rally, it found support, I mean, near the 21 DMA, currently forming another base. What's the stage base? Stage count?
Stage two, yeah.
Yeah, stage count. Stage count 2, so relatively a lower stage base and ideal stage at this moment. And so, I mean, considering the stock is 10% to pivot, you have the ideal time to have a look, study the chart and everything. If you look at today's moment, the stock moved higher, but the volume was relatively lower. So that's, I mean, not that good of a sign. But even the stock is not showing any signs of distribution. So that is a big plus during the base formation. Going forward, if the stock shows signs of good accumulation going forward, and even the RS lines moves higher and the breakout happens, it can be a really, really good stock to watch out for. The other can be dynamic tech. Sorry, Dynamatic Tech. Dynamatic Tech. Yeah. So relatively smaller cap stock, as one can see, and but I mean, what's interesting is that even in the small cap that it has, the fund holding for the stock has been improving very, very well. And similarly, you can see good buyer demand coming in. Price strength for the stock is also coming in. The first breakout for the stock wasn't that successful. The stock did re-break out, and but it's still coming back to its ideal buy zone. I mean, it's there at the pivot at this moment. But as you can see, for the last few days, the stock has been falling, and post the first breakout, the stock showed signs of distribution. That is, you can see 4 to 5 days, the stock sold on above average volumes, which is not a good sign. So, I mean, if the stock probably comes back to a 21 DMA, rests there, and then I mean, finds support and then moves higher on above average volume. Here, looking at the price volume becomes very important for this stock. I mean, not just the price action, because the stock has shown signs of distribution post the breakout. Probably again, if a clean breakout once again happens on good volumes, then maybe it can be considered. Because if you look at the fundamentals, the last 3 to 4 results for the stock has not been that good, and even the return on equity for the stock is not good. So, I mean, maybe, I mean, considering the other stock that we have discussed, it can, relatively, it can be an avoid. The next stock we'll discuss is Gabriel India. Yeah, thank you. So, I mean, one of the leading auto ancillary stocks. I mean, market cap is kind of on a smallish phase, but on the pitchforks, on the front forks, so this stock, I mean, this company has been doing very well. And similarly, you can see the last 3 to 4 results for the stock have been very good. I mean, the past breakout has been excellent for the stock. The stock found support at the 21 DMA, never breached its 21 DMA. If one is holding the stock post the breakout, can continue to hold so, because and you've been sitting on decent gains. The stock has almost doubled from your buy point, and during this entire rally, the stock has never breached its 21 DMA. On intraday basis, it did, but it managed to recover that. And going forward, 21 DMA can be kept as a stop loss level. If not a stop loss, but at least a partial profit booking zone. If 21 DMA gets breached on above average volume, at least 50% of the profit can be booked out. If being a conservative investor, you want to book out the entire profit at the breach of 21 DMA, even that can be done considering the support that the stock has been getting on the 21 DMA.
Thanks, Wakar. I'll take few queries now.
Okay.
I'll start with the IGL. IGL has been trading in a very long consolidation for the nearly and a half of nearly 6 months of period, and it is the stage count is 1C. That is after stage 1B of consolidation. It has again come under another stage of consolidation, and during this base formation, as you can see here, these key moving averages have been breached, and those levels are currently reclaimed recently, that is today especially, and it is still what 7% from its pivot. So this is a long way for the stock to break out from the consolidation base. On the fundamental front, the rating is very good, EPS rating of 81, and return on equity is also very good at 20%. But price strength has deteriorated to a poor category of 30. That is majorly because of stock breaching its 200 DMA. On the other side, Nifty scaled new all-time high at that particular point of time. But this stock has moved in a reverse direction to the market. That is the reason price has come down to poor category. But the buyer demand is staying intact. That is majorly because of very long blue towers, that is indicating a good amount of accumulation happening in the stock, and the selling is happening on the lower volume. But we need to wait for the stock to break out from this base pattern, and another 7% from here will be a breakout. And from until that time, RS rating will also improve definitely, and definitely the evening season will also play a very pivotal role for the stock movement going forward. And if you are already holding this stock in your portfolio, uh, the key moving areas are very close towards from the current market price, and the long-term moving average, that is 200 DMA, can be kept as a stop loss. That is another 5% from here. Next is Sun Pharma. Sun Pharma has broken out from its double bottom in the month of June or at the end of the June. And from there, it has advanced more than 20%, and currently it has been consolidating in a flat base. It is trading in a very narrow range, and currently 50 DMA has been tested, and it is trading very close towards its 50 DMA. That is less than 1% from the 50 DMA. On the upside, the pivot is at 3%, and for the stock to move at 3%, there might be some overhead supply as well. But the volume has been staying very on the lower side. That is a positive sign. That is the reason buyer demand is also higher. But the price trend has deteriorated. That is majorly because the stock has consolidated sideways, whereas the market moved here. This current particular market more than overall market and general market has moved higher in this period of time. And from 3% from here will give a very positive sign that is a breakout. Definitely can consider for the breakout as a good entry point. And if you are already holding the stock, 100 DM is another nearly 5% from here, but that will be a very long time to wait. You can exit when the stock falls from this level on a higher volume. That can be kept as a stop loss as well. Next is Vedanta. Just by looking at the ratings, you can clearly say what is our view on the Vedanta stock. You can see all the ratings starting with fundamental of EPS rating of 17 and technical ratings price strength of 5, buyer demand of C plus. All the ratings are clearly pointing a very bearish sign. We would definitely will definitely not go with these kind of stocks to our portfolio, and we would not definitely consider these kind of stocks to our buy watch list as well. It has been in the news for major reasons because of debt and other reasons. So we are not much into those topics, but looking at the price volume action, the stock breaching its key moving averages on higher volume, and it is not able to reclaim those levels. That is definitely a bearish sign. One could have exited this stock at this level when the stock breached its 1500 EMS, and those levels are currently way above from the current market price. Definitely not a good stock at this particular point to invest on the both or momentum strategy wise.
Yeah, thanks, Rajshekar. I will take few questions. So there are a lot of questions coming from the real estate sector. So
Okay.
can you please get me chart for the Nifty real estate Realty? So I think Rajshekar has discussed in the opening part only about the trend in the Nifty Realty. So it's been very good. If you can see over here, since last 6 months, it's in a confirmed uptrend. And couple of time it found very strong support near 50 DMA, and from there it had rebounded very strongly. So our other trading team has also given a call on this about the realty sector 1 month back, 2 months back, and from there has been exceptional momentum in the stock. So that was a technical, but overall, if you look at the fundamentals over here as a realty sector, the consumption is in India is increasing, the middle class is growing, right? And there is a rapid pace of urbanization. So during the COVID, there was a break in the pace of urbanization. But I think the post-COVID, there is a pickup in the real estate sector, especially the luxury projects. So if you look at the luxury projects of DLF, Oberoi, they are getting a very, very good response everywhere. And one more thing that has changed in last couple 2 to 3 years, that is the preference has been given more and more to the organized player. So this listed organized player who are having a good brands, they have been given a preference. So whenever you look at the new launch of these, big companies, these big guys, the absorption rate is very high. And if you specifically look at the higher absorption rate of new project launch, then you go to NCR, Bangalore, the absorption rate is very, very high. And if you come to the Mumbai, you just look at the last 4 to 5 months registration. In fact, even though there was some monsoon in the month of August and September, but in 2023, the August and September were the best month. Like if you compare it with the past years of August and September, and since last 5 to 6 months continuously, more than 10,000 registration has been done, and not only in the terms of number of registration. ऐसा नहीं है कि market नीचे गया है और लोग लेने को निकल पड़े. Even if you look at the value is also very high. So it's a volume plus value. दोनों का game है, and the inventory level is very low. All the tier 1 cities where these big listed players are doing well, the inventory level is very, very low. So all these factors, combining with the strong macro tailwinds is helping the realty sector as a whole. And all these listed companies are outperforming. So there are many companies, but I've given a general overview on the realty sector. So we already have a technical view from our TradingSmith team. So you can get that view from there itself. The report will be shared on the Twitter. It's already available on the MarketSmith website as well. But let's take a couple of stocks also, and then we move to the few other questions. Let's go to DLF, Raj. Then we go to Prestige. So yeah, DLF has been in a good momentum. It is finding good support near its 50 DMA. So it broke out in end of March or beginning of April from a cup base. And since then, it's been an uptrend. So the breakout was around 420 rupees. And from there, it has already moved around 35 to 40% in just 4 months. So this is a very good momentum. In between also, it gave a one chance. वो 50 DMA को breach कर दिया था, and then again it reclaimed the 50 DMA on a good volume, giving the alternate buy area. So overall, the buyer demand for the stock is very good. I think if you look at the EPS trend looks a bit poor, but as the Rajshekar is showing the data over here, you can see the number of fund holding has increased. And overall, if you look bearing the last quarter, so उनका earning momentum बढ़ रहा है. So DLF EPS front, it was a weak on since last 1 or 2 years, but compared to last 2 years, it has improved a lot, right? So that's what you need to watch out for. With that, though the rank is 49, but it has improved in the earnings in the last few quarters. So overall, it's a good technical setup, but currently it's much extended from its buy zone. So fresh entry according to O'Neill is not suggested. But yes, those who are holding the stock, I think the 21 DMA is always the first level for a stock that is in uptrend to watch out for. The second level is the 50 DMA to look out for. The next we can take is Prestige. So here also some similar setup. So it gave a breakout from cup with handle base pattern some 3 to 4 months back, and then there was a strong momentum from there. And again, it formed a base on base. You can see over here, Rajshekar is indicating. It had formed, I think, yes, a stage 2 base. That's a consolidation base. And after its breakout in August, again there was some good momentum. But हाँ, वहां से एक quick pullback आया था. But देखो 50 DMA, the red line is the 50 DMA. It multiple times it tried to breach the 50 DMA. I think for a couple of weeks it attempted there, but it found a good support there. And then again, since last 5 to 7 sessions, it has been in a strong uptrend. So the 50 DMA was around 600. So 600 के around support लिया था last month in September. But now the prices moved almost 20% from there, and now we are at around 720, 725. So that's how these key moving averages are always useful. And if you look at the earnings of the Prestige still, so last 1 or 2 quarter, if you compare, it's been on the lower side. But before that, the overall earnings for the Prestige is quite decent. And with the improving demand and the value that the new property is getting, I think the earnings are poised to improve for the real estate sector. Now let's move to the other queries. So I think I gave a general idea about the sector as a whole, and we took a couple of stocks. Now let's move to one YouTube query, and so that's on the Trent. Disclaimer that this stock is part of our model portfolio, and we had added it after it broke out from stage 2 flat base. So after the addition, the stock went higher with a good momentum. But I think since last 6 to 7 weeks, it is moving sideways and consolidating, oscillating around its 21 DMA, and also its 50 DMA is moving higher, and the stock is now close to 50 DMA as well. So let's see how it behaves around 21 and 50 DMA. I think if we see that the 50 DMA is broken on a relatively higher volume, then that's a good time to book profit or cut losses. But if it rebounds from here, that is somewhere around 21 and 50 DMA, if you see a strong reversal candle on a relatively higher volume, then the stock might resume its uptrend again. It can go to a fresh new high. So at this point of time, I think fresh buying or selling is not suggested in Trend, but yes, the buying can be suggested when it rebounds from 50 DMA on a higher volume, and selling if it breaches 50 DMA on higher volume.
Yeah, thanks, Rashid. I'll take in some queries. So we'll take APL Apollo. So as Raj is pointing out, the stock broke out from a to a consolidation base and it moved higher. It touched nearly 1800. Then it went down. It found support near the 50 DMA and it's rebounded very well from the 50 DMA. Raj, can you show me the volume bar? Yeah. So on the rebound, yes, the volume was higher. So it's a good sign, as you can see on what Raj is pointing out on the rebound. It rebounded well. Overall, fundamentally, a very good story. And plus, even the I factor is working very well for the stock. Someone who's probably bought the stock at breakout can continue to hold it. I mean, considering the stock is in the ideal profit booking zone, if being a conservative investor, one can probably book out some profit out of it and let the remaining run and can keep the 50 DMA as the stop loss level or I mean the profit booking zone or I mean cut out your I mean to cut out the position if the stock moves lower on above average volume on the 50 DMA front. The 50 DMA for this stock is very important. As you can see, during the entire rally, it found support at the 21 and then later half at the 50 DMA. Next stock we can look at it is yes, IRB Infra, then Maruti. As Raj is pointing out, the stock is forming a stage one consolidation base. The only issue with this stock is the EPS strength. The EPS strength is very poor for this stock and which is not working well for the stock. The earnings have for the last couple of quarters have been erratic and similarly can be seen in the price front as well. I mean, the stock has been forming base on base patterns, but I mean, the base is very uh, the base is very large, big, and very untimely base, as you can see. Not a clean base at this moment, and so this probably the breakout hasn't happened yet. So someone would not be holding the stock. If from a previous breakout, someone would be holding, then when the stock would have probably moved lower to the key moving averages, one would have booked out. If is currently holding the stock maybe from a previous breakout like a 32.9 kind of levels, then can keep the 21 DMA as the stop loss level or even the 50 DMA. But 50 DMA becomes again too big. Considering your risk appetite, can keep the 21 or the 50 DMA. Or watch out for volumes. If volumes come in, can definitely exit the stock. The next can be Maruti. So finally, the stock has broken out from a double bottom base. As you can see, this again, the stock has been forming base on base pattern. The run up has not been that good. I mean, the stock is, I mean, the stage count is not improving vertically, but on the horizontal front, that is not from 1, 2, and 3, but 1A, 1B, 1C. So the advancement is not more than 20-25%, and that is why the stage count is changing laterally, mainly because I mean, even when the markets were in rally for the last 6 months or so, the price trend for the stock is 51, which is not that good. I mean, the stock is not relatively outperforming the market. But considering the last breakout, one would have bought it at this breakout, considering it was a very clean breakout, can continue to hold so. And even today's session is very positive. As you can see, the 21 DMA got reclaimed on above average volumes. So if one has bought for the stock on the breakout, can continue to hold so, and probably keep the 50 DMA as the booking out zone. The 21 DMA at this point is too close, and the 50 DMA can be kept as the 50 DMA is around 5.65%, was Raj is pointing out. And if the results turn out to be good, then maybe the stock can move higher. But again, all depends upon street estimates. If street estimates get beaten down, then maybe the stock can give some beating, and you need to exit the stock. So at this moment, we'll take in some YouTube queries as well. So we'll take one on KEI. So disclaimer, the stock is there in our watch list as well. You can clearly understand why. Good prior uptrend for this stock. Discussing this stock in the pre-well as well. Currently forming the stage 2 cup with handle base, and overall all the ratings for the stock is very good. Plus the fund holding for the stock is also improving, and the only thing that the stock is not being able to do is probably provide a clean breakout. That is, the handle formation is still getting extended, and the stock is not able to break out on above average volume. So once probably a breakout happens, and if the volumes remain supportive, then it can be a really, really good stock to watch out for, considering all the parameters that we've discussed. I mean, the ratings, the technical factor, the I factor, and even on the fundamental front, the stock has been delivering very well. But if the breakout doesn't happen, and the result date comes closer, and then maybe we need to avoid the stock if the breakout happens very close to the result then.
I think Sukar, I'll take few queries now. There are a few banking queries. I'll start with ICICI. One of the leading private banking space, uh, ICICI, it has been trading in a very flat base, precisely to the stage 1C flat base. And recently it has tested or breached its 100 DMA and 50 DMS. Currently it is trading very close at its 50 and 100 DMS. And on the EPS front, it is looking very good. The company has been able to generate a good growth in terms of sales and EPS, even though it's a market cap of nearly more than 6.5 lakh crores. Still, the company is able to generate 30 to 40% of growth in terms of sales and as well as EPS. That shows the overall the capability of the company on the large scale. However, on the technical front, it has been an underperformer. You can see it has been forming it has formed a stage 1 saucer base and followed by a flat base and another stage 1C flat base. That is the reason RS rating has taken a hit. On the when the market is making new highs and Nifty Bank also has made a new high, this stock has been moving sideways. That is the reason the RS rating has taken a hit. Poor buyer demand is indicating a negative technical rating, especially that is majorly because the stock falling and higher volumes on a couple of or more in a more than a couple of occasions. It has fallen on more than higher volumes. That is indicating a good amount of selling happening in the stock. But if you look at the number of funds section, clearly that section has been staying intact. Look at the magnitude of funds that are invested into the company. More than 2,000 funds are invested, and the number is increasing. Again, showing the uh, growth momentum or the company has still intact. And let's wait for the company to report their earnings. The earnings are expected very soon, and if the company reports a good set of numbers, definitely this RS line will also improve, and the breakout happens on a good volume. Definitely a very good stock to watch out for. Let's go back to Nifty Bank and look out for the major index, how it is playing. We have talked about in the beginning of the session as well. You can see here Nifty Bank has been trading a very at a very crucial level at its 50 and 100 EMS are very close to the current market price. Uh, Less than 1%, all these moving averages are placed. So, and once these levels are reclaimed, there is a less than 4% of overall supply. Definitely, these stocks such as ICICI, HDFCs come up with good set of numbers. Definitely, those going to act as a good starting point for the market, or especially Nifty Bank, to act as a good good point for the breakout, and the Nifty Bank is expected to make a new all-time highs as well after good earnings from these big companies. Next is IndusInd Bank. IndusInd has broken out from its stage to flat base, but after the breakout, the stock has been moving sideways. It has not found required momentum for the stock to make a new highs and advancing from the pivot. But the overall market is also not so constructive at the particular point. We have seen Nifty trading near 30 EMS, and Nifty Bank also we have seen recently. It is still there is some overhead supply. If those levels are reclaimed, definitely these breakouts which have happened in the past can act as a good stocks or starting point for the buy watch list, and these stocks definitely will give good returns once the market or Nifty Bank makes a new highs. Definitely these stocks will definitely outperform. On the EPS front, the stock is very good at of EPS of 78. And if you look at the earnings specifically, the EPS and sales have been growing at nearly 20 to 30% for the last 4 to 5 quarters. Again, a positive side. RS rating is slightly on the lower side at 50, but if you see, RS line has been hitting a new all-time highs, and Newland's formation indicates a very good constructive sign on the technical front. So let's wait for the stock to come to the ideal buy zone, and by the time if the Nifty Bank also exhibits good momentum, definitely this stock is going to be an upward performer going forward. And if you're already holding this, 100 MA is another 3% from here. That level can be kept as a stop loss going forward.
Yeah, thanks, Raj. I'll take in some queries now.
Sure.
Just randomly taking in some queries. We'll take Bombay Dine, then RVNL. Yeah. And barring the EPS strength, I mean, just can you show me the earnings? I mean, why the earnings is so poor? Yeah, it's mainly because of the last couple of quarters. That is why the earnings rating for the stock is this poor. The overall, the fund holding for the stock have been improving, and the stock broke out very well. And as you can see, it was a clean breakout. and the stock is there has been a land sale for the company as well. I mean, so good cash holdings will be coming in for the company, and similarly, the stock has been moving higher, and it hit the power pivot, and the stock is now 65% above pivot at this moment. So someone who would have bought it at the breakout can continue to hold so. And if the stock breaches the 21 DMA on above average volume, I mean, can wait considering the 21 and the 50 DMA is very close. So, I mean, 50 DMA can be kept as your ideal stop loss line. And if 50 DMA gets breached on above average volume, can definitely exit it out. Why? Because I mean, morely the stock has been moving not because of the earnings, but because of other factors. Because and the earnings for the last couple of quarters have been very erratic. The other is RVNL. Yeah, I mean, considering all the railway stocks, even this stock was in extreme momentum for the last 1.5 year or so. If you look at it from a 1.5 year perspective, the stock has been a 10 bagger, as you can see, from more than 2025 levels from the first breakout. Has been more than it's nearly at 165 at 160 CMPs around 165 levels. And the previous stage count, if you look at for the stock, is the stage 5 count base. So I mean, yes, I mean, euphoria can take stocks higher, but you need to be very cautious and be rule based when you're trading in stocks. And as at only we always suggest that late stage count bases are very dangerous bases. So maybe from a stage 4 count, the stock rallied, but at the stage 5, you can see the stock is getting jittery, and I mean at the highs near the 200 levels, it um, it fell down very. I mean, on above average volumes, you can see signs of distribution. There's signs of reversals there, and currently the stock is trading below the 21 DMA, and it's not able to reclaim the 21 DMA. So someone would have probably bought not at this breakout, but very earlier breakouts. Can at this moment continue to hold. Why? Because the stock is not showing any signs of volume here. So if 50 DMA gets breached out on above average volume, then definitely exit the stock. Why? Because you're already there at a significant amount of gains. So protect the gains and move into, I mean, the other good breakouts that are happening from early stage basis. Raj, can you take just a couple of queries and probably wrap this session, as we have already hit our 1 hour mark at 5:30. Raj, you there?
Yeah, sure, Vakar. I'll take a couple of queries and we can call it a
Yeah.
session. We are already at 5:30. First, I'll talk with CDSL and some of the other stocks which are asked in the YouTube session. CDSL has broken out from a stage 1 flat base recently, 1 month ago. And from there, there was a very good follow-up buying, but from there it was moving sideways only. The volume has also dried up, but recently the last 3 trading sessions, it has found good buying, but is not able to close in the upper half of the trading sessions. That has been done in the today's trading session. It closed near the day's high as well. So we can say some kind of buying interest has coming into the stock. Overall, on the earnings wise, the stock is looking very good at a EPS strength of 90. Price strength is slightly in the lower category at 51. That is majorly because the stock has been an underperformer. It has breached 200 EMA, and it was recently reclaimed in the month of June. Until then, it has clearly traded below the 200 EM that showed underperformance of the stock. But currently, that underperformance is gone, and currently the stock has been coming out of the pivot range and clearly outperforming the majority of the stocks. And RS line has also made it on new high that is indicated by the formation of a blue dot that shows rally is still intact. Buyer demand is also very good at B plus. So if you are taken the position in this particular stock on the breakout, you can continue to hold it. And you can say 50 DMA, which is another 11%, and that is very close to the pivot as well as a stop loss level for the stock. Next is IEX. Another stock related to the exchanges, or you can say very directly related to the stock market involvement. This stock has been forming a very long consolidation base, precisely stage one consolidation base. And during the base, you can see it has been very erratic, we call it, and it has breached 200 DMAs and 100 DMAs as well. Currently, it is trading below 200 DMA and above 50 DMAs. We would like the stock to reclaim these levels going forward, and there is still 18% for the stock to break out from the current market price. Even though the EPS strength looking good, technical ratings are not so looking good. Price strength of 22 is a very poor rating. Number of funds invested in the stock are also going down, indicating bearish signs. So overall, it is not looking good on the momentum strategy wise. We would like to exit these kind of stocks, or we would like not to add these kind of stocks to portfolio as well. And sorry for not taking all the queries, but due to time constraint, we are not able to take all your queries. But I'll definitely take Britannia and I'll close the session. But the overall, uh, what I would like to say is looking at these stocks and our approach, if you are able to understand our approach by looking at ratings and price volume action, it is a very that is our overall objective for the participants here. We would like everyone to understand our canceling methodology rather than looking at all the stocks. If you are able to communicate our strategy to all the participants here, that is a very plus point to us. Next is Britannia, and we can call it a session after this stock. Britannia has broken out in the month of April, and it has moved up higher from there, but it has not found good momentum after breakout. Technical ratings have taken a hit. You can see here price strength has come to poor category. Buyer demand has also come to poor category. Definitely not a positive sign. EPS is still intact. That is majorly because the earnings are the company reported on the higher side. Let's see how the company reports are come up with their September quarter results. And the technicals, it is still beaten down stock. Let's see how the stock reacts after the earnings. If there is any consolidation from here, and if the earnings come out very good, definitely these these ratings will also improve going forward. Thanks everyone for joining. Sorry we could not take all your queries. You can write to us on email. We'll definitely take time to answer your queries. As I mentioned, our objective is not to take all the queries, but our objective is to communicate about the cancel methodology and our approach on how we look at stocks more specifically. Thanks everyone for joining the session. I think we can call it a day and have a good evening, everyone.